At 2:17 a.m., Daniel Carter sat alone in his small apartment in Ohio, staring at the glowing screen of his laptop. The word on the screen didn't blink. It didn't hesitate. It didn't explain. Loan application, rejected. No human voice. No phone call. No explanation. Just a decision. A decision made by artificial intelligence. But here's the real question. Can an algorithm truly understand a human struggle? Or does it only see numbers? Stay with me, because this isn't just Daniel's story. This is the story of millions of Americans whose financial future is now decided by machines. Daniel wasn't irresponsible. He wasn't lazy. He wasn't reckless. He was 29 years old, a software repair technician, hardworking, honest. For 6 years, he had saved every extra dollar he could. His dream: to open a small electronics repair shop in downtown Columbus. Nothing big. Just a small place with his name on the door. Carter Tech Repairs. He had calculated everything. Rent. Inventory. Marketing. Emergency funds. He needed $45,000 to start. Not millions. Not venture capital. Just a small business loan. In the past, he would have walked into a bank, sat across from a loan officer, explained his story, his passion, his plan. But this was 2026, and things had changed. Now, the decision wasn't made by a person. It was made by an AI-powered lending system. The bank Daniel applied to had recently upgraded its approval process. They advertised it proudly. Instant decisions, smarter lending, powered by artificial intelligence. Behind that marketing slogan was a powerful machine learning model trained on millions of financial profiles. The AI didn't just check credit scores. It analyzed spending behavior, monthly transaction patterns, subscription services, debt-to-income ratio, social financial stability signals, employment consistency, location risk data, even behavioral probability trends. Within seconds, the algorithm compared Daniel's profile to millions of previous borrowers. It calculated one thing: the probability that Daniel would repay the loan on time. To the system, Daniel wasn't a person. He was a risk percentage. And that percentage wasn't good enough. When Daniel saw the rejection message, his chest tightened. He refreshed the page. Maybe it was a glitch. Maybe the system misunderstood. But the results stayed the same. Rejected. No explanation. Just a polite automated email. Based on our advanced risk assessment system, your application does not meet our approval criteria at this time. That was it. 6 years of savings. 2 years of planning. Hundreds of hours of research. Reduced to a probability score. And here, where the emotional weight hit hardest. Daniel's credit score wasn't terrible. It was 682. Not perfect, but not reckless either. He had never declared bankruptcy. He had no criminal record. He had stable income. So why? What did the machine see that he couldn't? Have you ever wondered what invisible data companies collect about you? What patterns are shaping your financial reputation without you even knowing? And if a machine labels you as high risk, how do you defend yourself? Daniel's story isn't unique. Across America, AI lending systems now approve or reject millions of loans annually. Fintech companies claim AI reduces bias. They say machines are objective. They argue algorithms don't discriminate. But experts warn of something deeper. AI learns from historical data. If past lending patterns contained hidden bias, the system may repeat them. Quietly, systematically, without intention, but with real consequences. In Daniel's case, the algorithm detected subtle risk indicators. 3 short employment gaps over 6 years, a recent increase in credit card utilization, living in a zip code categorized as moderate business risk. None of these alone were catastrophic. But combined, the probability score dropped below approval threshold. To a human, those details might be explained. To AI, they were statistical warnings. Daniel didn't give up immediately. He contacted customer support. The reply was automated. Please review our financial improvement guidelines before reapplying. Guidelines: improve your debt ratio, lower credit utilization, increase savings. But Daniel already lived frugally. He didn't dine at expensive restaurants. He didn't travel abroad. He worked overtime shifts. Yet the algorithm had judged him. Without conversation, without empathy, without context. And here's the chilling part. The system would continue learning. Every rejection strengthens its predictive model. The machine becomes more confident, more efficient, more powerful. But does it become more fair if your entire financial future depended on an algorithm? Would you trust it blindly? Or would you demand transparency? The United States leads the world in AI-powered finance. Major banks use predictive modeling. Digital lenders approve loans in under 60 seconds. Fraud detection systems analyze billions of transactions daily. It's efficient. It's fast. It's profitable. But it's also transforming the relationship between humans and money. In the past, financial decisions involved conversation. Now, they involve computation. And the shift is happening rapidly. By 2030, experts predict over 90% of consumer lending decisions will involve AI assistance. That means millions of Daniels, millions of silent judgments, millions of unseen probability scores. 3 days after the rejection, Daniel sat in his parked car outside the empty storefront he once imagined renting. He stared at the for lease sign. He imagined the neon logo, the workbench, the customers walking in. All paused, not by failure, not by laziness, but by code. He whispered to himself, how can a machine decide I'm not ready? And that question is growing louder across America.